All right, we are back for another Friday financial wrap-up without Mr. Michael Zuber. Michael's actually traveling back home. He will be on next week. This is the Friday Fast financial wrap-up. This is for June the 21st, 2024. Let's get right into it. A very interesting week. The Fed fund rate, what's going on there? There's been a lot of talk, a lot of criticism and opinions both sides. Should the Fed cut rates? Should they not? Should they hold? Continue the pause? We've talked about this at length over the last several months. And what's going on this week? Switzerland, actually, the Swiss central bank cut rates for a second straight time. And then if you watch the show, you'll know a few weeks ago, Canada became the first G7 nation to cut interest rates. The UCB, what is the UCB? The ECB. What is the ECB? It's the European Central Bank. They also cut rates 25 basis points about 2 weeks ago in early June. Now Neil Kashkari was very vocal this week. Who is Neil Kashkari? Michael talks about him. If you're a regular watcher, listener to the daily financial news, he is the president and CEO of the Federal Reserve Bank of Minneapolis. So he's one of, I believe it's 19 members. And of course, so this week, Neil Kashkari talked very openly about the fact that he believes the Fed should not cut rates until December. Now, if you're a regular viewer of the show, if you're a listener, you know Michael's talked about he believes the Fed is weighted and that they're probably going to wait until November after the election. Michael expects, he's still sticking to it, 50 basis points in November. Neil Kashkari, he's talking about December now. So we see other global nations, they are beginning to cut rates. They're making moves. The U.S., apparently, there's still a lot of concern about housing costs. Of course, you all know, right? Inflation, it's still in the grocery store. It's still in retail. So we will see and time will tell. Now, if we keep moving forward, we'll look at what happened for May resale numbers. Home sales suffered the third worst month in the last decade, the last 10 years. Now, for the month of May, 20% of all transactions in the month of May had a price reduction. Very interesting. Days on market were up to 32 days. Now, folks, you know, if you've been watching the show for a long time, days on market continue to grow, continue to climb. And then also what's interesting, prices are still up 5.1% year over year. So again, crash in housing. Michael's talked about this for, again, the last 6, 9, 12, 18 months. There is a real estate crash, but it's not a crash in values like a lot of the doomers on a lot of the other YouTube channels are talking about. But in fact, it is a crash in transactions. And of course, again, the month of May, third worst month in the last 10 years. Let's keep going. Redfin and Zillow, we of course know them. They're the juggernauts of real estate data, big search portals. Both of them agree, looking for a forecast predicting that the housing market, Redfin predicting over the next 12 months down 1%. Zillow now also forecasting the next 12 months down 1.2%. So what does that mean? Not a lot, right? We're up right now 5, 6, 7%, depending on what reports you're looking at. We see that the housing market, yes, it is softening for mediocre inventory. There are still cities in lots of places with demand, and there are other places where you have increased inventory. Also, again, we've talked about it on the show, properties that are mediocre, properties that are maybe a little neglected, those properties are soft. We are seeing longer days on market. We are seeing price reduction. So is this a crash? No. What we're seeing is a market we believe to be normalizing or hopefully moving towards normal. So let's continue. Thursday's jobless report. This is the unemployment report. The claims fell by 5,000 to 238,000. Now, this was down from a 10-month high last week. I actually covered that last week. 243,000 unemployment jobless claims last week. New claims versus the expectation last week was 220. So when I compare last week to this week, looking at unemployment claims, the actual was 238,000 versus 235,000 expectation. That's a miss. It's 3,000 more unemployment claims. That's about 1.2% in terms of a miss. Higher, of course, not good news, but ultimately did not move the market compared to last week. Last week, it was a 10% miss, 240,000 3,000 unemployment claims versus they were expecting 220,000. That is market moving, 10% versus 1.2%. Again, Fed's looking at this, the bond market, the equity markets. Everybody is holding their breath to see what's going to happen with unemployment, what's happening with these inflation numbers, and of course, what is the Fed's next move? Time will tell. Let's keep moving forward. This week, 30-year mortgage interest rates averaging top-tier conventional 30-year fixed rates just a hair over 7%. And that seems to be the average this week. Now, of course, Wednesday was a holiday, the Juneteenth holiday, so there was no bond trading. But ultimately, just not a lot of activity in terms of rates moving around. We're going to probably see, last week, I had reported last Friday, 6.9, 6.8 rates finishing the week. This week, we're just a hair over 7. Probably still going to be in that same range going forward into next week, finishing out the month, unless we have some financial hiccups or surprises. Now, a couple of things to note. Michael talked about in the Daily Financial News this week that he believes, and he's still holding to, which I also agree, that demand, meaning that where we really see a spike in buyer demand and we see those crazy multiple offers, is probably somewhere 6.7. I think 6.5, 6.6, maybe even under that 6.7 threshold. We start to see things loosen up a bit, or maybe get into this kind of craziness of the market. Ultimately, looking forward, I still believe we're probably stable somewhere in the high 6s, low 7s, and just bouncing around based on the headlines for that day or week. And finishing the show strong, let's take a look at some celebrity real estate. New York Yankee legend Derek Jeter finally snags a buyer for his New York castle. Yes, that's right. Derek Jeter sold his home finally. It was listed in 2018 for $14.25 million, and it actually just sold for $6.3 million. Now let's take a look. Derek Jeter's his nickname, Captain Clutch, right? For his, of course, being one of the great New York Yankees. If we take a look, that is actually very beautiful. Absolutely gorgeous. Now, this home actually 12,500 square feet, 6 bedrooms, 13 baths. And again, original list price, $14.5 million, sold for $6.3. You have it, folks. There it is. Enjoy your weekend. Thank you so much. Michael Zuber will be back next week. Folks, if you like, please subscribe, comment, share. Thanks for watching. Have a great weekend.